Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Parmar.
Welcome to the Monday section of Wealth Matters podcast. Hope all of you are doing great. I want to talk about, and I have mentioned in this video where we spoke about inflation, and also I have mentioned about how you can kind of beat inflation. So today I want to go back and mention the same thing again. Actually, if you would have forgotten about it, I have mentioned that there are Series I savings bonds or I bonds available through treasurydirect.gov. It's by US government. They are the best risk-free way to earn more than 7% over the next year. So if you still have some cash sitting in a money market certificate of deposit, short-term treasury, or other risk-free equivalent, there are ultra safe income producing bonds that you need to consider right away. They come from US government, same entity helping fuel inflation with its multi-trillion dollar stimulus programs. And they're specifically designed to counteract the ravages of inflation. Normally, I would never recommend buying bonds in a higher inflation environment, but these bonds are a little different. These special US savings bonds pay roughly between 89 to 108 times more income than the average savings and money market accounts. So if you are looking to keep a small portion of your safe money in cash while keeping pace with inflation, these bonds are the perfect investment to add to your portfolio. Again, I'm not advertising for US government, but this I-savings bond have holding period from 12 months to 30 years. You could own them as an alternative to bank CDs, right? Or bonds in your portfolio. New inflation numbers were just announced, which allows us to make an early prediction of the May 2022 savings bond rates a couple of weeks before the official announcement on the 1st. This also allows the opportunity to know exactly what an April 2022 savings bond purchase will yield over the next 12 months instead of just 6 months, right? You can then compare this against a May 2022 purchase. So September 2021 CPIU was 274, March 2022 CPIU was 287. So that's a semi-annual increase of 4.81. So using the official formula, the interest rate for the next 6-month cycle will be 9.62%. That's crazy, 9.62%. So if you buy before the end of the April, the fixed rate portion of I bonds will be 0%. So you'll be guaranteed a total interest rate of 7.12% for the next 6 months. For the 6 months after that, the total rate would be 9.62%. That's amazing. Who can give you guaranteed 9.62%? I don't see any other investment which can give 9.62% annualized which is guaranteed by US government. If you buy in May of 2022, you will get the 9.62% for the first 6 months, but then we don't know what will happen after 6 months, right? So you have to decide, do you want to buy during April or do you want to wait till May? Buy now or wait. Given that the current I bond rate is already much higher than the equivalent alternatives, I would personally buy in April to lock in the high rate for the longest possible time. Who knows what will happen on the next reset, right? The annual purchase limit is now $10,000 in online I bonds per social security number. So for a couple, that's $20,000 per year you can put into this. Or if you have kids as well, you can use their social security and you can put another 10 grand each. So for me, like I can literally put $40,000 per year. And again, I'm not planning to do that, but I'll definitely put like $20,000 and just wait to earn my 7% for first 6 months and then 9.6% over 6 months after that. Also, one other important thing I found is that you can actually buy if you had paid additional tax. I never believe in paying additional tax, so I never have refunds. at least for the last 3 years. I usually end up paying more, and I'm fine with that because that means I was able to leverage that money and that money stayed with me. But if you are paying more tax right upfront and then you are getting refund, you can also buy an additional $5,000 in paper I bonds using our tax refund with IRS form 8888. So this is also pretty good because even though the limit is only $10,000 per Social Security per year, but if you have a refund, you can automatically apply that refund and buy about $5,000 worth of savings I bond. So as I said, saving I bonds are unique low risk investment that are linked to inflation and only available to individual investors, right? So and they are again unique because they don't lose their value even if the interest rates run higher. So it's also important to note that while I bonds earn interest for 30 years, if you redeem them for before 5 years, you will forfeit the latest 3 months of interest. So you cannot redeem them within a year. So you have to hold at least for 12 months. And if you, after 12 months, if you decide to redeem at month 15, then you will lose the last 3 months interest. So if you hold it for 5 years, then you can pretty much redeem them anytime and you will not lose any kind of interest. So you can actually use this safe income to buy small stakes in cryptos and other positive asymmetric investments that could end up being more profitable than all of your safe income combined. So I am going to take this action, and I highly recommend that you take this action as well. If you are listening to this or watching me on YouTube, that go ahead and buy at least some treasury I bonds. And again, that's because I'm going to do this. I'm not giving you any advice, but that's my recommendation because I think this is a great way to beat the inflation. So you should go back and look that if you haven't heard, the consumer price index CPI came in at 8.5% year over year. That means the basket of goods the government has determined regular people buy has increased in price by 8.5% in the last year. So if you are keeping the money, let's say $100 in your bank account, it's at the end of year one, it's worth $91.50 if you just focus on CPI. But another fun fact for you is that the equation used to calculate CPI was changed in 1978. If we use that original equation today, CPI would be at roughly 17%, an all-time high. Another inflation metric that we can look at is the producer price index, PPI, which measures the inflation of input costs for producers. Currently, PPI is at 15.2%. In US history, it was only higher than this for 2 quarters in 1974. And why I'm giving you all this number, let's start looking at the inflation numbers. The government right now has only 2 options, 2 choices. They continue to print, they continue to provide stimulus, which they started way back in 2009, 10, or 11, and the inflation will continue to go up. Or they decide to curb this printing, they decide to tackle this inflation and start raising interest rates fast, which can cause recession, right? And because of this, start looking into your investment, how you are managing your money. And this is why I mentioned about treasury I bonds. I'm not, of course, affiliated with US government. I hate their policies, what they are doing. But there's one of the good ways for you to, instead of keeping your money in savings or CD account, if you are, just buy some treasury I bonds. So at least you are able to earn 7, 8, 9% of interest per year. And if you do it right, then you may be able to even write off that interest as well by investing in real estate and other depreciable assets. But again, I'm not a tax advisor. I'm not a financial advisor. I try to share what I am doing with my own money. So continue to follow me on YouTube and Apple Podcasts and let me know what you guys think. And please leave a review or provide a feedback. Thank you so much for listening and watching. Have a great week.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing.